the market's going to crash. The real estate market is going to crash. All the prices are overinflated and we're heading for another great recession, just like we saw in 2008. So if you're listening to the mainstream media, that is what you're hearing right now. You're not hearing the honest truth about your local real estate market. You want to know something funny? If you ask the majority of real estate agents if they believe the market will crash, they're always going to say no, right? Because they want you to keep buying and selling. Also, the vast majority of real estate agents aren't very aware of what is truly happening in the market because they don't take this business too seriously. Now, this video isn't going to be about bashing real estate agents because honestly, it's just not ethical. And I also want to answer the big question that I keep hearing. Will the real estate market crash again? Well, if you ask me if I believe the real estate market will crash here in Pennsylvania, I would also say no. But I do believe we are headed for and currently seeing a correction. There is a significant difference between a crash and a correction, which is what I will be discussing for you today, and if Pennsylvania is headed for a crash. In order to do so, we have to paint the picture from the last housing crash and what we are experiencing right now. Although it may feel the same to some, there are some severe differences between the early 2000s up until 2008 and then now until 2022. So let's take a look back and revisit history so we can compare it to now. There were several interrelated factors at work. First, low interest rates and low lending standards fueled a housing price bubble and encouraged millions to borrow beyond their means to buy, and they just couldn't afford the home. There were buyers getting loans for 120% of the appraised value of a property, which is absolutely insane when you think about it. These borrowers were so overleveraged that when the bottom fell out, they took a massive hit. Second, the banks and subprime lenders kept up pace by selling their mortgages on the secondary market in order to free up money to grant more mortgages. Third, the financial firms that bought those mortgages repackaged them into bundles and resold them to investors as mortgage-backed securities. When mortgage defaults began rolling in, the last buyers found themselves holding worthless paper, which was the beginning of the mayhem that ensued. This caused real hardship to many people. Their homes were literally worth less than what they paid for them, and significantly less. They couldn't sell their houses without owing a ton of money to their lenders. And if they had adjustable rate mortgages, their costs were going up as their home's value was going down. The most vulnerable subprime borrowers were stuck with mortgages they couldn't afford in the first place. So if you're asking yourself, who is to blame for all this? Many economists place the greatest blame on the lax mortgage lending policies that allowed so many consumers to borrow far more than they could afford. But there's plenty of blame to go around, including the predatory lenders who marketed home ownership to people who could not possibly pay back the mortgages that they were offered, the investment gurus who bought these bad mortgages and rolled them into bundles for resale to investors, the agencies who gave those mortgage bundles top investment ratings, making them appear to be safe, the investors who failed to check the ratings or simply took care to unload the bundles to other investors before they all blew up. I bring up all this not to relive the past and bring up your PTSD, but I want to compare what is happening right now in the current market to what it was like back then. Because the current market is not really in any kind of way the same it was during the Great Recession. I'm going to break this down for you to give you further clarity. Let's take the predatory lending that happened during the Great Recession years and compare it to what it's like in 2022. Since the beginning of COVID, the real estate market has taken off and seen unprecedented numbers, from home value increases to rock bottom interest rates. Also, the lenders have become way more strict with their lending standards, which is a direct opposite of what it was like before. I personally purchased 2 properties in the past year, and let me tell you, I had to jump through so many hoops to do so. Now, I know my situation is different than most because I'm partially self-employed as well as employed by my company, but it was still challenging. Lenders today are not nearly as risk adverse as they were back then. As a borrower, you have to be solid with a stable income, some assets in the bank, and you have to have good credit. It is a stark difference today compared to then, and no one that I have seen or even heard is able to borrow anything close to 120% of the appraised value of a home. So with lenders being more strict and less risk adverse, that is a good thing for the overall market. Now let's take a look at home values. Prior to the Great Recession years, home values were also skyrocketing. From 2003 to the first quarter of 2007, US home prices rose more than 38%. In the 12 months leading up to February 2022 alone, home prices jumped 18.8%. But there are substantial differences in the tale of the two housing markets. First, there's the overall supply of housing in America. From 2000 to 2010, US home builders produced 27.1 million homes. In the ensuing decade, the number plunged to just 5.8 million. This lack of production has led to a serious supply crunch in today's housing market. While that may not be great news for home buyers, it does mean that home prices' current uptick may be more sustainable than what was seen in the mid-2000s. Since home values have been continuing to rise these past 2 years and the amount of inventory has not been able to keep up with the demand, we will certainly see home values increase more. Now, I don't believe we will be seeing an increase like we have been, but something more modest, around 3 to 5% per year, which is pretty standard, especially in my market of Chester County. We will continue to have home value increases because the inventory will remain low for the foreseeable future. Home builders just can't keep up with the demand, which means less new construction inventory will hit the market. And I believe that more baby boomers will want to age in place rather than move into smaller housing or retirement communities, which will also put a strain on inventory. Less people will want to sell their homes where they have a favorable interest rate of 4% or less and then buy something for 6% or more, right? That's just common sense, it seems to me. All of these factors are going to continue to add to the inventory crisis we are seeing now, which was not the case from the early 2000s. We have also seen more wealth growth in the past 2 years than we did before, and a lot of that is coming from home equity. With all the volatility in the current market, real estate has become one of the central asset classes for many investors. Stock market's down, crypto's down, the value of the dollar is decreasing, but real estate is still such a safe bet. So with more investors taking their money and putting that into real estate, taking it out of the market, and investing heavily into properties, you can see that the market shows no signs of collapse. But like I mentioned before, I do believe it will at least correct. So what exactly do I mean by that? In the past few weeks and months, I've seen many more price reductions from listings than I've seen in a very long time. There was a stretch where sellers were literally listing their homes for a price and they were getting substantially more for that property. Are over asking and bidding wars still happening right now? Absolutely, but not to the extent of what we saw from late 2020 until the beginning of this year. The main drivers for the price reductions we are seeing right now are high interest rates, inflation, and unrealistic sellers. With interest rates increasing so dramatically these past 4 months, buyers' purchasing power has decreased, which in turn has pushed some buyers out of the market completely. The interest rate dilemma has no signs of coming down either, so it will cause more buyers to not be able to afford a new home, unfortunately. With unaffordability happening, coupled with the unrealistic sellers trying to hit a grand slam when they list their home, and high inflation rates, we will continue to see price reductions happening in the market. And since real estate is such a strong asset class, these factors will not contribute to a market crash, but more of a correction and a leveling off. This will also cause there to be more opportunities for buyers who are willing and able to stay in the game. If less homes are selling for higher asking prices and less buyers are being able to afford homes, this in turn should help to increase the amount of active inventory. I don't think it's going to help the overall inventory level though, which is what I was touching on before. And what I mean by active inventory level is the month's supply of inventory. Right now in Chester County, the month's supply of inventory is around 1.2, and hopefully by the end of the year that will creep up to 2, 2.5, and maybe 3, but I don't know about that. In any case, the real estate market for the vast majority of Pennsylvania will continue to remain strong, and it shows no signs of a crash anytime soon. Real estate is always a hyper-local thing, so when you're doing your research on where you want to buy next, make sure that you're consulting with a local professional. And if you are looking to make that move to Chester County area and you would like to speak with a high-producing local professional agent, make sure that you click on the link below to do so. Thank you guys so much for watching. If you have any questions, comments, let's chat. Drop it in the comment section below. I want to get a conversation started. I want to make sure that I'm giving you valuable information and that if you have questions, they are being answered. As always, thank you so much for watching. Look forward to speaking with you soon.